If you've been hunting for ways to boost your income in 2025, you've probably heard about the GraniteShares YieldBOOST ETFs. They're new, flashy, and promising some jaw-dropping yields. But are they worth the hype? And how do they compare to tried-and-true dividend ETFs that are already delivering consistent returns? In this video, we'll break it all down: the strategy behind YieldBOOST, the risks, and a look at some of the best dividend ETFs performing right now. Let's start with the basics. GraniteShares launched a series of YieldBOOST ETFs designed to generate income by selling weekly put options on leveraged funds. Here are the main players: TSYY, which tracks Tesla's leveraged exposure; COYY, tied to Coinbase; NVYY, based on Nvidia; and XBTY, tied to Bitcoin. Instead of just holding these volatile names, the funds sell puts against them, which creates premium income. That income gets distributed back to investors, sometimes translating into triple-digit annualized yields on paper. For example, TSYY has posted yields north of 100%. Sounds incredible, right? But as you'll see in a minute, there's no free lunch. So how do these ETFs actually function? Think of them as a mix of high-octane growth exposure with an options income overlay. The puts they sell bring in steady cash flow, but they also expose investors to downside risk if the underlying stock or crypto falls sharply. There are a few key things to remember. First, these are short-term trading tools, not buy-and-hold investments. Second, the leveraged structure means performance compounds daily, which can erode gains over longer periods if the asset moves sideways. And third, the distributions are variable. They can swing wildly from week to week depending on volatility. So yes, the yields can be eye-popping, but they come with significant risk, and you need to actively monitor your positions. YieldBOOST ETFs might appeal to experienced traders or income seekers who understand options and volatility. If you're looking for aggressive short-term yield and you're okay with risk, they might fit your strategy. But if you're a long-term investor who prefers steady, predictable returns, there are safer roads to take. Now let's compare YieldBOOST to some of the top traditional dividend ETFs that are shining this year. On the international side, the Pacer International Cash Cows 100, ticker ICOW, is up about 17% over the past 12 months with a 4.4% yield. Its sibling, the Global Cash Cows Dividend ETF, ticker GCOW, gained around 13% with nearly a 4% yield. The Global X Super Dividend EAFE, ticker EFAS, is up close to 30%, paying out around 4.5%. And the iShares International Select Dividend, ticker IDV, delivered a strong 26% return with a yield above 5%. In the U.S. market, the Capital Group Dividend Value ETF, ticker CGDV, posted around a 20% return this past year. Meanwhile, staples like Schwab's SCHD and Vanguard's VYMI continue to provide solid yields in the 3.5 to 4.5% range, without the roller coaster risk that comes with leveraged options strategies. So here's the bottom line. GraniteShares YieldBOOST ETFs are exciting and innovative. They offer massive income potential, but they're speculative and carry high risk. On the other hand, traditional dividend ETFs may not give you a triple-digit yield, but they deliver steady income, solid performance, and peace of mind for long-term investors. It really comes down to your investing style. Are you chasing aggressive short-term income, or are you looking for reliable growth and dividends you can actually sleep on at night? If you found this breakdown helpful, don't forget to hit that like button and subscribe for more ETF insights and market updates. And let me know in the comments, would you take the chance on YieldBOOST, or do you prefer the safer path with dividend ETFs like SCHD and CGDV? Thanks for watching, and I'll see you in the next one.